Started with the first one several years ago, been to every one since. It's a great mix of hedge funds, both large and small, including some great emerging talent, also some fantastic investors, endowments, foundations, and family offices, including many who particularly look at the best and brightest emerging managers, or let's just say smaller managers under the $1 billion mark. Trends on the allocator side are pretty interesting times now. Some of the multi-billion dollar funds are doing great, but a lot of them have had issues. It has not been a straight up with every large hedge fund, so investors are starting to roll up their sleeves and get down to brass tacks and look very closely at managers of all sizes and all strategies in terms of trying to see what are the fundamentals, who's running the money, how good are they, regardless of size, regardless of strategy. And these are very, very interesting times because emerging managers are now being looked at closer because all the big funds are not doing well. Well, first of all, it's kind of funny. The term emerging manager is a bit of a misnomer. I mean, most emerging managers have been running money for 5, 10, or 15 years, typically someone who's come out of another shop. So the irony is that most emerging managers aren't emerging. It may be a new fund, it may be a new vehicle, it may be a new team, but they're not emerging. So what we're looking for and what our investor base is looking for are fundamentals. Where did they come from? What have they done? What is their strategy? What are their risk controls? How diversified is the portfolio? How do they come to their investment decisions? Basically, follow the bouncing ball from the very beginning of where they get their investment ideas to how they put together a portfolio, how they use leverage or don't use leverage, and literally get to know everything that manager does from the moment he or she gets into the office first thing in the morning until they leave. This has been a very interesting time for quant. It used to be probably, let's say maybe half of our investors would do quant funds and half wouldn't. But most investors are now sort of waking up to the notion that quant is not really a strategy. I mean, it sort of is, but quant is sort of how you get to the place. So for example, we're talking with a manager right now, great team, great 12-year track record. They're really long-short equity. They're long-short equity, large cap, low net, great top decile returns. The way they get to their positions happens to be quant. So are they a long-short fund? Sure. Are they a quant fund? Sure. And more investors are now looking at the potential of investing in great quant funds if they meet all the other criteria. So in a time where, let's say, most large multi-billion dollar funds are doing well across the board, investors can just invest with the usual suspects and so forth. But now they're looking at smaller managers, looking at quant funds, and fundamentally, who are the people, what are they doing, and does it make sense that they can add alpha to our investments in a diversified, hopefully less correlated way, quant or otherwise. And one of the things that came out of the conference this morning at some of the panels that covered emerging managers is infrastructure, people, pedigree, and process. So I think across the board, there's probably roughly, say, 24 things that ideally every hedge fund and hedge fund manager should do. Say about 24. And whether you're emerging manager, under 100 million, under $1 billion, or whether you're multi-billion, let's say probably half of those anybody can do. Out of the other dozen or so, there's probably half that you can outsource, another 6, and then another 6 that if you're under $1 billion, you're probably not going to get to. But what sophisticated investors want is they want that roadmap. So they want to see a fund, whether it's 1 million or 1 billion, have people in place, risk management in place, on either an in-house or outsourced basis, covering, let's say, 12 to 16 of the check-the-box items. For the other half dozen or dozen or so, what they want to see is some of it outsourced perhaps, but then a roadmap. So for example, one of the best things that an emerging manager can do is their org chart. On their org chart, they've got, let's say right now, 3, 4, 5, 6 people, but what they should also have are boxes of people they're going to add when they get to certain asset levels. So they've got 5 or 6, 7 people on the org chart and spaces for another 4, 5, or 6, whatever they need. And if they want to take it even further, they can then color code certain people coming in at certain asset levels. And what that says to investors is that the emerging manager or sub-billion dollar manager gets it, that we have most of the people in place, we're covering most things, we're checking most of the boxes, but we know that we need a few more, and we're telling the investor, okay, so when we get to 250, 500, or billion, then we're going to do it. And investors can look at that, take a big deep breath and say, okay, these people, these guys, these gals know how to run a fund, and they've got a roadmap to take this thing to $1 billion and beyond. I mean, that is one of the reasons that whether you get a great marketer in-house or third party, one of the things a great marketer can bring to the table is obviously money, and more money from great investors, but the real smart ones who've been down this road for a decade or more not only know the investors, hopefully, but also, let's call it the marketing tricks, how to put together a pitch book, regardless of a fund side, that is going to be compelling and show investors you've got a roadmap to grow the business. And some of the top marketers will help you with your documents, they'll help you with your presentations, even sometimes help you with the hiring in terms of here's what you're going to need to be a success. So for example, one fund that we're working with wasn't sure if they needed a CFO or COO, full-time, part-time, and we suggested it strongly, and guess what? They then started hearing about from other investors they were meeting with, well, who's going to be your CFO, who's going to be your COO, and then they listened to us and we put together a bunch of candidates for them to speak to who will add a lot of gravitas, and specifically CFOs and COOs who have actually taken hedge funds from the $100 million mark to the $1 billion mark, because that is a perhaps somewhat different skill than someone who's only been at gigantic funds. And that also goes to the type of marketer and fundraiser you have. As someone mentioned on one of the panels today, if someone is a $100 or $200 million hedge fund, and especially if they're smaller, they probably would not want a marketer who's been at a multi-billion dollar shop and is going to be going to every multi-gazillion dollar pension and endowment whose minimum ticket size is $100 million. It's probably not going to be a good fit. You want to go with a marketer and a fundraiser who's been with $100, $200, or $500 million funds, and while they also probably know the large ticket writers, will also know the family offices, the fund of funds, and the pensions and endowments that will look at emerging managers and can write the $25 to $50 million check. So it's got to be the right marketer for the right fund and the right CFO for the right fund, given the size and the stage that they're at.